we don't want to be necessarily looked at as a chain and just kind of have this one all-in-one experience for users to come and do whatever they want with their money. USDC actually with the spike right now is generating 5% as backing. We could redirect that 5% into that vault as well. So now that your retail users are earning 13%. We can also take from the taker people using VBUSDC, VaultBridge USDC, which is our margin on the perp decks. We can make it even 14, 15%. And then we add CAD tokens on top to make it that kind of magic number of 20% to get people out of bed.
Today, I'm joined by Matthew Fisher, CEO and co-founder of Katana, a DeFi-first chain built around the premise that the blockchain can own its liquidity and still deliver sustainable real yield. In this episode, we tackle the hard questions. Is chain-owned liquidity a genuine structural breakthrough or just protocol-owned liquidity with extra steps? How do you build a yield model that survives a bear market when every chain before you failed to? And what does it take to get Sushi, Morpho, Gauntlet, and some of the best risk minds in DeFi all building inside one chain instead of on top of it? We're covering all that and much, much more. These are the questions most DeFi founders dodge, but we do not. Matthew, welcome to the show.
Great. Yeah, thanks for having me. Nice to be here.
Thank you too. Please tell us more about your background and what led you to found Katana.
Yeah, for sure. So I joined Katana about a year and a half ago when it was still kind of like an idea. I don't know if the name Katana was around yet, but some of the tokenomics and stuff like that was decided. I've been in crypto for about 5, almost 6 years now. Was on started at Libra, working on kind of Facebook, stablecoin, and kind of blockchain. Definitely passionate about DeFi and moved into the DeFi protocol side. At a small team led by this financial historian who kind of built these different liquidation free lending protocols, this decentralized exchange specifically built for yield bearing tokens and kind of some stablecoin stuff. And as a builder, definitely recognized the fatigue of adding like more chains and more general purpose chains and liquidity just being very mercenary and hopping from place to place, chasing yields alongside the fragmentation, just kind of harming some of the utility around it. And so when I kind of talked to the team about around Katana and then like eventually took over, really agreed with like the vision and kind of thought that the future of change really is being purpose built and verticalized.
Building a chain instead of a protocol means you control the full stack, right? The sequencer, the liquidity, the yield infrastructure, all of it. Most teams never attempt that because the coordination cost is enormous. What does owning that entire stack unlock for Katana that would have been impossible if you had built a protocol on top of someone else's chain?
Yeah. So at Katana, we're a revenue generating business and seek to kind of be that. We've made various moves, including acquiring a Perpdex, which is the highest revenue generating application on any chain. We also, by the time this podcast goes out, we'll announce that we acquired the AMM instance on Katana as well. So earning the spot dex and the Perpdex. We have our own application that kind of is a holistic view of all these different utility where you can kind of come. It's like kind of opening up an Apple computer where a lot of this stuff is kind of pre-installed for you and you don't have to kind of like search around for like what it is. So I think that's like part of it. We have a pretty exciting vault product coming out soon as well. And so the idea is kind of redirecting all these revenue sources and back into driving value to the ecosystem. Vault Bridge is another kind of topic around that, which I'm sure we'll get into as well.
Yeah, yeah. Look, every cycle has its version of sustainable yield, right? That turns out to be mostly emissions in disguise. Katana is one of the few chains that has engineered yield from actual chain activity. Sequencer fees as well, breach revenue, and letting demand. Now, what does the yield composition actually look like today versus what you have projected at the start?
Yeah, for sure. So um, again, Katana's built for builders by builders, and so we understand that tokens kind of come and go, and emissions aren't extremely sustainable, and obviously result in more price pressure. So one thing we designed with Katana is like this source of sustainable yield that is called Vault Bridge. And so what happens is the USDC, USDT, ETH, and Bitcoin that's bridged from Ethereum mainnet to Katana is lent out on Ethereum mainnet. And then all that yield goes to the foundation, which we can then redirect as another source of yield. So in March, we generated about $600,000 of revenue just off Vault Bridge alone. I think we're at around 4.5 million since launch, and all of this has been reinvested into continuing to grow Katana. You can imagine at some point in the future we can kind of do other things with it, but for now, we're basically trying to give users better risk-adjusted yield than they have on other venues. Obviously, token emissions is a component of it, but the differentiator of Katana with uh, this setup is a like another source of additional yield.
Sushi and Morpho are the core of how Katana delivers value to users. How did you structure those relationships so that what is good for Sushi and Morpho is also good for Katana long term?
Yeah, for sure. So on the Morpho, I mean, in general, the idea was to concentrate the liquidity incentives on like one core protocol per primitive. And so not having competition at the base, like infrastructure layer per se, but having app builders and vaults and people that are kind of built composable applications to compete on top of it. So with that, we kind of looked at the landscape of DeFi and like who we kind of wanted to work with or who we thought met our bar. And so a big part of that is obviously security. And so we had Polygon security team. And I think we deeply audited a lot of these contracts, had different discussions on the future of DeFi with these different partners and there's various roadmap synergies with some of them and some others. And on Morpho's side, like we are sober enough to know that in some ways crypto liquidity on chain is like tapped, and so you really want to kind of expand outside to more of like the normie user base and like the TradFi institutions and all this other stuff. And Morpho is a very flexible, composable infrastructure layer that many people have kind of trusted and built on top of it with a very simple code base. I think it's like 500 lines of code, which is very, very, very sleek. And so we're excited about that and really like that partnership. And I think yeah, they've built a lot of trust over the past few years. And then on the Sushi hand, like again, like super battle tested, been around. That code base has been around for like 5 years. They had a big team that wanted to put a lot of resources into Katana. They had expanded to a big multi-chain vision, and then wanted to kind of concentrate on one before then like expanding again. Actually, by the time this comes out, we'll be able to announce that we acquired the Sushi instance on Katana. So this kind of goes to the vertically integrated chain that we're talking about, where we kind of like own the spot decks, the perp decks, etc., and then we can build kind of things on top of it. The one thing that's nice about Katana is you can just be an asset issuer, come to Katana, you can talk to like one entity, and we can line up with like all of these different kind of use cases, which I'm sure we can kind of get into more.
And yeah, look, most yield products in DeFi are a black box, right? So Katana publishes exactly who is managing the risk, Gauntlet and Steakhouse Financial, what parameters they operate under, and what happens if things go wrong. Now, how much did that level of transparency change the conversations you had with users and institutional allocators?
Yeah, for sure. So because of the way Vault Bridge works, the curator selection is extremely important, and the risk that would be taken extremely important because when you're holding USDC, USDT on Katana, you're taking the risk of like these different Vault Bridges on the L1, and so super important that those are safe and secure. So the Prime vaults that back those are like the safest in crypto in terms of only accepting Bitcoin and ETH and lending out stablecoins against it. I think we have people on the team who have been using a lot of these protocols and know their team for quite some time now, to the point where there was this big kind of kelp Aave exploit on Saturday night, last Saturday in April, and we were like very on alert for it, sharing up liquidity and available liquidity to allow users to withdraw. I think we were the most liquid L2 of any chain that was able to service like 20 million from like one institution and a bunch of others as well that wanted to take risk off the table and take money kind of like off chain. That's all kind of kudos to all of the way we thought about risk and parameters and asset selection. And so there's been various vulnerabilities with Kelp. There's been vulnerabilities with Resolve before that and Stream Finance last fall. And these all have resulted into like potentially like bank runs and potentially different exploits and hacks and all this other stuff. We weren't vulnerable to um, any of those details, but I think they are very far-reaching implications that does have effects no matter if you're exposed to them or not. And so I think we made explicitly very different moves to enable this. Yeah, and reassure users that I think in the immediate term, like this definitely sacrifices some TVL, but in the longer term, it really builds in additional trust for users to know that even under very extreme circumstances, they can still kind of get their money out. And so yeah, we're happy about that.
So the stabilization window is one of the more thoughtful early staker designs in DeFi right now. We built a fee structure that actively redistributes value from short-term sellers to long-term believers, the way I understand it. So, could you please walk us through the thinking behind those numbers and what you expect the staker base to look like once the window closes?
Yeah, 100%. So when we were approaching TGE, um, I guess taking a quick step back, Katana is the first chain to ever introduce VE33 at the chain level. The other common implementations have been through Curve and Aerodrome over the years, which basically allow people to stake their tokens and use the stake token to vote and direct emissions, which then result in directing kind of liquidity on the AMM or decentralized exchange. So what Katana did is we built that with Aragon, and we built it in a way to be a generalizable locker that can be embedded throughout other use cases in addition to the AMM. So we have designs for Morpho and designs for the Katana Perps, and we're kind of like seeking to create deep utility for Katana and ways for users to participate in the ecosystem. So first implementation of that went live on day one with Sushi on the AMM side. Um, we couldn't really predict exactly what yields would be generated through staking cat, and I don't think like anyone really can. There's a bunch of different factors in it. The way that it drives yield is it has these things called bribes, which other protocols can use to try to direct liquidity for their own asset. It also accrues yield through exit fees. So if you unstake cat, you have to pay a fee to people that do stake cat, and then it also accrues fees through trading fees as well. And so again, extremely hard to predict what kind of trading fees are going to be day to day. Hard to predict how much what the exit fees would look like too, and then pretty hard to predict the bribes as well. So with all of that, I think we needed to create some kind of program that gave users who were fortunate or believed enough to stake their tokens and earn yield a kind of floor yield and compensate them for taking uh, this like early risk or like believing kind of in us, because there is a large exit fee in the first stabilization window where it's a linear decaying model, and the exit fee becomes less and less. But we wanted to be able to compensate users for this unpredictability in the yield source. I think after the stabilization window, which is a 60-day period following TGE, we will have more data on the yields. And so users can kind of come and go with more understanding of what they are really earning for the risk and time. Um, I guess like the time costs, time cost of money, and the ability, I guess, really the illiquidity versus liquidity risk, and how that kind of like works on Katana. So that's like kind of the premise of it, is we wanted to basically create some program that acknowledges people that were here before us. And it actually was only exclusively for people that had farmed cap before Katana went TGE. So the foundational window was not actually available for everybody. It was only for people that had already participated in Katana for the 8 months since launch last July. So yeah, I think it was one way to kind of show our commitment to our early believers and supporters. And obviously, in this market environment, like you're never going to appease everybody's expectations on price action and FTVs, especially early on. And so I think this is like one kind of callback to show that we like cared about our original supporters.
Most governance systems in DeFi fail because participating takes too much time and expertise. Now, Katana essentially lets you set it and forget it with AV cut, right? So, how do you think about the balance between people who want to be hands-on and people who just want the yield without the homework?
Yeah, for sure. So that has definitely been a big point of friction in VE tokenomic systems before, is, hey, I don't want to come every week and manage it and continue to vote. Like it's kind of like a bit headache, but at the same time, I want to like optimize my profitability or yield. And so maybe I'll just sit out if I don't feel like doing this. Or maybe I'm interested in this token, but I see everybody else is earning yield, but I don't want to have time to like kind of go that. So maybe I'm getting diluted with like the yield just by holding the token. And so, fortunately for us, like with other parts of the design as well in Katana, is we benefit from those builders that kind of came before us, and so we're able to like learn from them. And so one thing we did was kind of create this version of cat, as you're saying. So just for the broader audience, basically you could take cat, which is the ticker of the token, stake that for VCAT. Now with VCAT, you can use to do these weekly kind of voting, participate in the ecosystem. You can actually take that VCAT and you can mint what we call AVCAT, which is like an auto compounded type of version of the token. And it's more of like a passive approach through like a relayer that someone has built that also basically optimizes what your preferences are and continues to kind of drive yield without you having to uh, manually kind of participate every week on your own, but given like a programmatic way to participate in the ecosystem. And
The
also,
emissions,
and
yeah.
also, by the way, so VCAT is kind of like this NFT version, right?
Mm.
Those that version of a token has is limited utility. What you actually need in DeFi is ERC20 to be able, or ERC 466. This is a token standard within DeFi that allows you to do other things. So now that we have AVCAT, it actually unlocks even more utility. So now with AVCAT, you can take it, you can deposit into Morpho, and you can borrow dollars against it, or you could even borrow more CAT and then use that to loop it and go pretty aggressive on CAT as well. And then, yeah, you can actually swap in and out of AVCAT on an AMM too. And it, again, just creates a lot more ways to create more things for people to do with CAT.
The emissions flywheel is one of the most powerful alignment mechanisms in DeFi when it's working well. So emissions attract liquidity, liquidity drives volume, volume generates fees, fees return to the people who directed the emissions. Now Katana has the additional advantage of chain-owned liquidity. Can you walk us through how that cycle works in simple terms, right? And what gives you confidence it holds up when the market gets tough?
Yeah, for sure. So, chain on liquidity is like a lot of people have talked about protocol and liquidity in the past, and chain on liquidity basically just means that now the whole chain like owns it rather than just like the protocol, and it's like owned for kind of for the users. And obviously, we have protocols within it, and we can use that to kind of direct liquidity to what like matters most to like the ecosystem. In terms of like the flywheel that you're touching on, uh, CAT emissions incentivize protocols to kind of come and deploy on Katana, and these different protocols attract TVL, like real users, real volume, and like that volume then generates more fees, which generates more for the sequencer, for the DEX, and utility around the lending stuff, which then has knock-on effects with the perps, and all of that. Because of like the way the flywheel works, um, a lot of these fees in these various areas can flow to VCAT holders and like stakers and the people who kind of vote on these emissions, the protocols that like earned them. So it's really just saying like, hey, if you participate in the ecosystem through your own activity is an important thing. It's like all what the user decides to kind of do with their own tokens. You can kind of be rewarded for that, and having like a base of chain on liquidity helps people so that even when some of these users or activity dries up, we have like a solid foundational base of liquidity that under any market environment and conditions, like bull or bear, will kind of continue to be there. So right now, I think it's only like 700,000, but yeah, you can imagine in a future world if it gets to like millions and millions, that instead of having to subsidize and pay institutional LPs to provide liquidity for volatile pairs like an ETH USDC, which is like one of the most expensive pairs in crypto, given impermanent loss, we can actually do that on our own, which also then reduces the amount of emissions we have to pay and reduces kind of like some sell pressure on the market. And then we also like will reiterate that a big part of the flywheel is the vault bridge stuff too, which you can use that to direct emissions as well. So yeah, a few different pieces of the flywheel that like we're excited about how we built, and we know it works at scale. We just kind of need to hit the escape velocity.
Let's stop for a minute. Here's a brief moment of context for those who may not know me. My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I work with executives and organizations as a growth and media professional. My focus is crypto, at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are discussed through conversations with people shaping the development of digital assets space. This is another thing that I wanted to talk about. Katana ships with ready-made templates, an MCP server, and an AI skills layer baked in. So, what kind of builders has that attracted so far, and what are they building?
Yeah, for sure. So we have this guy on our team who's kind of built this, yeah, AI thing. As you said, I think AI is definitely a big craze right now, with everything that's been going on. And I think it basically creates just more things for people to do and interact with. Um, and then yeah, I think in terms of the AI layer, we had a very wide variety of builders that came and experimented and sharing it in our developer channels on Telegram, and from like the dashboards that display kind of how state cat voting is distributed. They're building bots, position health notifiers, AI yield optimizers, and they're kind of continuing to experiment and mix the kind of the core ideas that bring the kind of the chain and like the ecosystem together. I think we urge builders to kind of like think about and rethink their visions at times, instead of kind of building like in isolation. They're kind of like more educated to build on top of the existing kind of core apps and infrastructure layer. And so yeah, I think that's they're trying to drive different unique user experiences, while kind of having like that base layer of liquidity, as we mentioned, the base layer of yield that they can kind of inherit, and they don't need to worry about more and more DeFi dexes and lending protocols coming. They can just focus on building a unique application over top.
Institutions are also coming into DeFi, right? And it's something the space has been waiting for, possibly for years. So, how are you thinking about positioning Katana for that shift, and what does the institutional user need that most DeFi chains are not delivering today?
Yeah, so I think a lot of DeFi chains like are delivering some of their needs and thinking about their needs as well. But I think in terms of what they do need, they need different like risk managers and your like audited and battle tested infrastructure that has kind of the ability of transparent reporting that you can kind of do on chain, and like counterparties that kind of have legal accountability, at least for now. Obviously in crypto we like to say code is law, but these institutions kind of get more comfortable on the relationship side before like moving significant amounts of capital, and need custody providers and all these kind of things, right? So I think in terms of what they need, like the DeFi has matured a lot over the past few years, but it's still like not there in some ways. I think regulatory clarity is coming and is kind of stirred even more interest for them as well. Some of them are still at the stablecoin stage and mesmerized by things like prediction markets and perps, but yeah, I think we are decently positioned for institutional DeFi as well. We've had a dozen or maybe 2 dozen um, institutions that have had like 8 figures of capital on Katana at one point or another, whether that's lending, borrowing, or providing liquidity. We've had like a digital asset treasury called GameSquare. They've had like significant amount of ETH. It was a publicly traded Nasdaq company on Katana as well. We have the Falcon X's, MNCs, Winter Music, all these other people have interacted with Katana at one point or another, and I think that kind of speaks to the security and the DeFi infrastructure that we've kind of built so far.
Every founder has a clear picture of what success look like. What does the version of Katana look like in 3 to 5 years if everything goes right?
Yeah, for sure. So I think last month when we had a TVL bump and drove $600,000 in revenue, um, that showed that like the model like does it reaffirmed the model does like work. And if we get to a point where it's tens of billions of TVL, you can generate like 6 mil like that. Like I think that would mean like $6 billion, 6 billion TVL, 10 billion TVL, it's around like $6 million a year in like real yield that which we can redirect. And then at that point, Katana really becomes like this home of the best risk adjusted yield and yield seeking capital in DeFi that can be protected and where your funds are like safe. Um, that is like one of like the use cases that in a few years we'd like to get to. And what that then unlocks is fintechs can come in and use Katana as their DeFi infrastructure. We have Polygon Earn, this kind of thing we're working on with Polygon, where fintechs come in, deposit on Polygon POS to cross-chain vault that kind of routes into Katana. So this kind of will attract like a lot of TVL. The other thing that we are working on is like is Katana Perps, which we recently acquired to bring more of the sophisticated traders over. And also with owning the spot decks as well, we kind of want to be this vertically integrated exchange that basically attracts people to kind of do whatever they want with their assets and execute any strategies that they want with their assets and kind of like enjoy while doing so with while earning different risk rewards than you would on another chain.
Now that you have mentioned Perps, this is a completely different story, right? It's a big story and it's a long-term vision. But how do you plan to compete with the existing solutions?
Yeah, for sure. So one thing that we are going to be releasing in by the time maybe this podcast comes out is this new vault product. We think uh, the convergence of vaults and perps has been like overlooked, and this team has been building this for quite some time now, and we're excited to finally get going with it. It's like a smart contract vault that is very flexible. It can be customized wherever. It can be whitelisted for liquidations to generate yield. It can do P&L sharing, uh, profit boosts. It can execute any types of strategies really. And so the idea is like don't trade against Wintermute, like be Wintermute and like kind of deposit funds with them to kind of run their strategies and allowing retail to access professional market making strategies. So when Katana Perps goes live for the vault, Oros, which is one of the top market makers on chain, will be running a vault and different strategies behind that. We have a few other partners that might be that we're working to kind of close to do that as well. But you can the first implementation is basically um, a fixed interest rate vault where retail users deposit into a vault. Maybe the Oros will borrow at like 8%, for example, and then they go provide that liquidity on the perp dex itself and drive taker activity there. And so Katana is in a great position for this exact product because of that vault bridge revenue. So all of the USDC actually with the spike right now is generating 5% as backing. We can redirect that 5% into that vault as well. So now the retail users are earning 13%. We can also take from the taker people using VBUSDC, Vault Bridge USDC, which is our margin on the perp dex. We can make it even 14, 15%. And then we add cat tokens on top to make it that kind of magic number of 20% to get people out of bed. Why that's important is because then instead of us paying market makers or subsidizing makers for liquidity, now retail is providing liquidity that market makers are then trading on, which then increases liquidity and utility, and then also can then attract people that don't historically use perps to kind of come and get exposure to it as well. So that's one part. I think we are working towards right now on 24/7 pricing and different Oracle providers on then expanding into commodities, RWAs, equities, and allowing people to trade all these different kind of assets as well.
The promise of DeFi was always that the rules are in the code, as you mentioned, and everyone can see them. However, in 2026, the chains with the most traction are the ones with the most curated, managed, and almost TradFi style guardrails. Is Katana a DeFi chain, or is it something new that we do not have a good name for yet?
Yeah, it's a fair question. The binary between like pure DeFi and TradFi with like smart contracts isn't necessarily completely true. Like I think they are have some like similarities, but yeah, I think in terms of what we're building in curated DeFi, as you mentioned, the rules still are very much code. Everything is still verifiable on chain, but there are also deliberate choices about like kind of which protocols are natively integrated and supported at the foundation layer and what risk managers are comfortable in terms of parameters for these different assets and like structuring DeFi. I guess what you kind of like mean. Um, yeah, I think in general we don't want to be necessarily looked at as a chain. We want kind of like the fact that it is a chain to eventually be kind of buried in the back and just kind of have this one all-in-one experience for users to come and do whatever they want with their money. And with that, like almost like a super app type of thing that is curated and provides users with different kind of risk profiles and different return opportunities to kind of get to what they want. But yeah, no, I agree that that makes it a little bit more institutional grade, and it's still a permissionless chain. Anyone can kind of come and deploy. Um, but fundamentally, like there are different ways you can design the chain's economy to kind of make it more um, like appeasing for certain types of market participants.
Every cycle produces a new primitive that everyone builds on top of before anyone has really stress tested it. Right now, that is modular yield vaults and restaking. How do you decide when a piece of infrastructure is mature enough to make it load bearing in your chain's core revenue model?
Yeah, that's honestly a really great question. When does a primitive get enough escape velocity or attention where a chain basically says like we have to kind of have that because if we don't, then our users are going to leave for something else. So I think chains typically kind of chase this maybe a little bit too much. And once liquidity kind of aggregates on one chain, like it begets other liquidity, right? And so, for example, we could take a few verticals as historical examples here of these new kind of emerging market types. So meme coins, right? They got really, really big on Solana. Other chains try to replicate it like Avalanche and did not go so well. Base had a strong enough kind of community and where they were able to do something around it in terms of like coin creation and stuff like that. So I don't think any of these other chains are even thought about when it comes to like meme coins, right? It's like Solana has been like this place for it. And there are other use cases and verticals that other chains can win on, but it's probably a waste of resources to go and try to compete on that. AI kind of shortly followed like this meme coin craze is actually kind of like a part of it. And it ended up developing pretty strong network effects on Solana and actually on Base too, and on Polygon as well with certain things. And if the way we kind of think about these as well. And you could throw prediction markets as well in there, right? And prediction markets are a great example. Like on Polymarket, all this liquidity has been aggregated, very deep markets. Same with Kalshi, very deeply integrated. Like you've seen other chains kind of have prediction markets. Like we have one that someone to put on their own. It's pretty tough to for those things to take off without kind of like a moat or competitive advantage or like why you have a specific chance or like reason to survive and kind of like own that primitive as well. So I think I just use those as an examples of even when like new innovative things come out from new use cases, that doesn't really mean that every chain on and every user will want that. I think the way we kind of think about it personally is basically let's have these let's be good enough that people aren't leaving for these use cases. So we don't need to be the home of AI. We don't need to be the home of prediction markets. We don't need to be the home of meme coins, but let's have enough here that if this thing really is an everyday use case, that people don't have to leave just to trade perps, right? Like at least we have perps. We might not be as deeply liquid as hyperliquid, but like um that's like kind of like a standard of that. I think the other thing too is it's not like really these new categories are being created every day. And it's not like you have to be there extremely early if they aren't like a category creator. Because if you look back on DeFi, which kind of started taking off 5 or 6 years ago, it's much of the exact same use cases that are around today. Uh, Swapping for new tokens on an AMM, lending and borrowing on a protocol. These are like these two everyday use cases. And now over the past few years, Perps has really taken off too. So there's kind of like these three really big everyday use cases for DeFi. Because we're only a DeFi chain, we don't have to expand off of the DeFi use cases, right? Like we're not going after gaming, NFTs, all this other stuff. All we're doing is focus on DeFi. So those are kind of these three core everyday use cases. Obviously, prediction markets are super interesting as well. Obviously, meme coins can drive a lot of user adoption, but it doesn't mean every chain kind of has to have all of it. So a long-winded way of saying like, yeah, good question, haven't answered it, but yeah, I think happy to answer anything further.
If you had to bet on one thing that kills the most DeFi projects in the next 2 years, not the obvious stuff like hacks and bear markets, what would it be and how does Katana avoid it?
Yeah, so I think DeFi protocols are coming up on having like a choice and will be at a crossroad at one point or another, given like the amount of funding and interest that the industry has. it's kind of either you can have like a slow death and try to survive for as long as you can with like looking kind of for product market fit and building into something that you think might be unique, or you can kind of double down and be a little bit more aggressive in the immediate and like short and like maybe medium term to try to get to that escape velocity. The fact of the matter is there's probably like 8 projects that are it's pretty clear that they will be around in 5 years. So I'm talking about Aave, Pendle, Morpho, um, Lido. Like these are some people that it's pretty clear like why they will have already hit that kind of inflection point and staying around. For everybody else, yeah, I think the question is like, do you have a product that people want? Do you have a product that people will pay for? Uh, do you have any competitive advantage? And that can mean like the product itself, or it could also mean distribution partners. Are you working with like a Phantom of the world or different like wallets, or does an exchange basically like own you, or have they integrated your vaults into their the product? I think these are some questions that they really kind of need to answer, and so that's like part of it. I think token value accrual has been something that has been definitely not, I guess, super clear over the past few years in administrations like in the US, and like why these tokens should be like worth anything. For Katana, we truly genuinely try to create and do something different around that with the VCAT throughout the whole chain. And we are trying to create different revenue streams, but I think revenue is going to be really, really important. And if your project does not generate revenue, I think you will be in a tough place.
As for the closing question, where is the best place for listeners to follow your work? Try Katana and stay updated on what you're building next.
Yeah, for sure. So I'm at mfisher10x on Telegram and on Twitter. Um, they can find me there. And I think the Katana handle and the Katana Perps handle are also pretty good finds too. And in our community, pretty much aggregates on Telegram and the Katana community chat too. And then you can check out our application at app.katana.network.
I will include all the links in the descriptions.
Amazing.
Matthew, thank you for joining and for being direct about the hard parts of what you're building. And to everyone listening or watching, like, subscribe, or follow both of us. Check out Katana and share this episode with someone curious.